Hi students, welcome to the video on double entry system of bookkeeping. Topic is Learn Accounting, a complete course from beginner to advanced. So, glimpse of the topic, that means topic to be covered today in this video is accounting equation, flow of account, structure of accounting means ledger accounts, golden rules of accounts, both traditional method and modern method, latest input tax credit rules related to setting of input tax credit, basis of accounting, that is cash basis and accrual basis, then preparation of journal entry, ledger and trial balance. So, all of you know, accounting equation tells assets is always equal to liability plus capital. So, we will solve some problem after discussing the flow of accounts and golden rules of account of traditional and modern method. So, what is flow of accounts? Under flow of accounts, first we have to understand the transactions. Before recording any entry or a transaction in the books of accounts or journal, first we have to understand the transaction, whether it's relates to financial or non-financial. If it is financial, then it will be taken into account. If it is non-financial, whatever may be the importance of the case, it cannot be taken into account. Then after understanding the transactions, we have to house the entry record. That means with sufficient documentary proof like invoice, bill, money received, credit advice, debit advice, we have to make the record. Then after making or vouch entry, that is making the record in the journal, it will be posted to ledger. So ledger is the books of secondary entry or final entry. Then from the ledger, we have to prepare account in T form. That means ledger is of T form. That means all transactions relating to a particular person or things will be written in the specified account. Then it will be balanced. How will balance? Means we will total both sides of the account. If debit side exceeds the credit side, then it shows the debit balance. On the credit side, we will write by balance carried down. Similarly, if credit side is heavier than the debit side, then it shows credit balance. On the debit side, we have to write to balance carried down. Then after balancing, we will prepare a statement known as trial balance. Trial balance is a summary of what is contained in the ledger. Then in the trial balance, we will take particulars and debit balance, credit balance. Mainly there are two methods of preparing trial balance. It may be totaling method or balancing method. Under totaling method, the two sides on account will be written and two sides total will be written on the debit and credit. Then the difference is the balance. But generally we prepare by balancing method. Particulars, debit balance, credit balance. Then at the end we will total both the debit balance and credit balance. If both total debit balance, total credit and total tally, then trial balance is correct. That means it serves as a an authenticity, or it shows as proof of arithmetical accuracy of books of account. That means there is accuracy in making the journal, posting them in the ledger, then balancing and preparing the trial balance. From the trial balance, we can prepare income statement, that is trading and profit and loss account, and as the balance sheet. From trading account, we will ascertain whether there is gross profit or gross loss of the business. From profit and loss account, we will ascertain whether there is net profit or net loss of the business. The balance sheet, it is based on the accounting equation, that is assets equal to capital plus liability. Yesterday video I also discussed. Against the assets of the firm, two parties are having claim. One is owner's claim, that is known as capital. Second one is outsider's claim, that is known as liability. Then what are the structure accounting, ledger accounts? In the ledger accounts, it is a two side. One is credit, another debit. So credits relates to, that is capital, liability and income are having credit balance. Then expenses, assets are having debit balance. That by taking into account the income and expenditure, we will prepare a profit and loss account and ascertain whether there is net profit or net loss of the business. By taking into account capital, liability and asset, we will prepare a balance sheet, and it proves that there is accuracy, that in the financial portion of business, so is a true and fair view of the business. Then regarding accounts, there are golden rules, like traditional rule means we will know for personal account, debit the receiver, credit the giver. For real account, debit what comes in, credit what goes out. For nominal account, debit all expense losses, credit all gains and income. By putting this formula or this golden rule, we will make the journal entry. Again, the modern method is very also important. Under modern method, we will put this formula. That means here it is under types of accounts. One is assets, second one liability, third capital or drawing, the income, profit, expense, losses. That I already yesterday's video I explained. There are 5 elements of financial statement. They are asset, liability, capital, income or profits, expenses and losses. That is revenue and expenses. Revenue expenses belongs to income statement, and asset, liability, capital belongs to balance sheet statement. Then rules of debit and credit under modern method, that asset and expenses, for asset and expenses one formula, increase in assets should be debited, decrease in assets should be credited. Increase in expenses should be debited, decrease in expenses should be credited. And reverse is the case of liability, revenue, capital. For liability, increase in liability should be debited, credited, decrease in liability should be debited. For revenue also, increase in revenue should be credited, decrease in revenue should be debited. For capital, increase in capital should be credited, decrease in capital should be debited. Then we will make some journal entries. First accounting question, then journal entry. Under accounting equation, we write this is particulars, then assets is equal to liabilities plus capital. Suppose it is given X started business with cash. Then under assets, cash comes to the business. Suppose it is 10 lakhs, then we will start cash with 10 lakh and liability is nil and capital is also 10 lakhs, then italics. Then second, deposited 5 lakh into bank, rupees 5 lakh into bank. What we will do? The cash will be minus, that is minus cash 5 lakhs. Then under bank, cash at bank, we will add 5 lakh. Then no effect in others, that is no effect. Then new question comes, asset is equal to now, under new question, cash comes 5 lakh and bank comes cash at bank comes another 5 lakh, then liability is nil, then capital is 10 lakh. Suppose purchase goods on credit from supplier. Purchase goods on credits. From suppose X. So here suppose its worth is 1 lakh, that will write 1 lakh. Here one is cash in hand, that is 5 lakh. Then another cash at bank 5 lakh. Then goods 1 lakh. So total 11 lakh. Then liability means creditor is also 1 lakh. Then capital is 10 lakh. Sold goods for cash. Sold goods for cash. Here suppose goods, here purchase, this is the goods or stock. So out of stock, suppose sold goods for cash for rupees, sold goods value or original cost 50,000 at 60,000. So from the stock 50,000 will reduce. Then if it is on for cash, then the cash 60,000 will add it. So we will add 5 lakh plus 60,000, that is 5 lakh 60,000. Cash at bank is 5 lakh. Then stock will reduce 50,000. So it is 50,000. Then liability is 1 lakh. Capital will be increased by 10,000 profit. So 10 lakh 10,000 capital, 11 lakh 10,000 total. Then purchase furniture. For cash, suppose rupees 4 lakhs. Then the cash 4 lakhs will be deducted and cash will be 1 lakh 60,000. Then cash at bank is 5 lakh plus 50,000 is the value of stock. Then 4 lakh is the cost of furniture. Then no effect. Here it is 1 lakh. Here it is 10 lakh 10,000. So total 11 lakh 10,000. Then here 9 lakh 50, 10 lakh 50, 11 lakh 10,000. Suppose paid salaries 2 lakhs. So what we will do? So paid salary is 2 lakh by check. So from bank we will reduce 2 lakh. This is 1 lakh 60,000 plus 5 lakh minus 2 lakh, it is 3 lakhs. Then stock is for 50,000, furniture is 4 lakhs. Then 1 lakh is this liability plus 10 lakh 10,000 expenses 2 lakh minus 2 lakh, it is 8 lakh 10,000. So total is 9 lakh 10,000. Suppose it is given rent outstanding rupees 1 lakh. So here everything is correct, that is 1,60,000 is cash, then 30,000 is here, 3 lakh is cash at, this is cash in hand, cash at bank, then stock is 50,000, then it is also 4 lakhs. So totally it is no change in asset side. Then liability rent outstanding is 10,000, so it is 1,10,000. Then rent outstanding is 10,000. Rent outstanding is, suppose this is rent outstanding 10,000 liability, then here 10,000 plus rent account debited to rent outstanding. So rent outstanding 10,000 plus then rent paid 8,10,000 minus 20,000, that is 7,90,000. What happened here? Rent outstanding, rent, that is 10,000 is outstanding. This is 1,10,000. Then here rent paid is, here it is 8 lakhs. So total is 9,10,000. So this is new, this is final equation. So this is all about accounting equation. This we can also discuss in journal. In case of journal, X started business with cash, two entities, there are two entries. One is cash, another capital. Cash is real account. We put the formula, debit what comes in, credit what goes out. So cash comes to the business. So cash account should be debited. And X started business with cash, means this is X capital, is personal account. Debit the receiver, credit giver. So first journal entry, cash account debited to X capital account. Then suppose 5 lakh deposited into bank, that is cash and another bank. Here cash is real account, debit what comes in, creditor goes out, cash goes out of the business, so it should be credited. And bank is the personal account, debit the receiver, bank is receiving cash 5 lakh, so bank account debited to cash account. Suppose purchase goods on credit from supplier or X, then goods comes to the business. So goods is our nominal account, purchase is nominal account, debit or expenses losses, so purchase account will be debited, and X is the creditor, that is giver, his account should be credited. So purchase account debited to X account. Then sold goods valued 50,000 or 60,000 for cash. Cash comes to the business 60,000 and stock goes out of business 50,000. 10,000 is the profit. So journal entry is cash account debited to, here if it is journal entry, will write only one entry, no profit will record, will write only cash account debited to sales 60,000. Then purchase furniture for cash, it is 4 lakhs. Furniture comes to the business, cash goes out of the business, so furniture account debited to cash account. Paid salaries, when we are paying salary, then we have to deduct 2 lakhs from cash, and here also 2 lakhs. Paid salary in terms of check, means we have deducted from bank 2 lakh. So salary is on Salary is the nominal account, debit all expenses and losses, salary account should be debited, bank is the giver of cash. So, salary account debited to bank account. From bank, we deduct 2 lakh, from capital, we deduct 2 lakh. Then, rent outstanding, journal entry, rent account debited to rent outstanding, rent will be closed by transferring to profit loss account, and rent outstanding will be shown on the liability side in the balance sheet. So this is all about also journal. Then we will discuss, or we will have a depth discussion on GST. GST, all of you know, that is goods and service tax. From on 1st July 2017, GST come into existence during BJP governments. Then we are paying 2 types of tax, one is direct tax and indirect tax. Then indirect taxes are submerged into one tax, that is GST. That's why it is known as one nation, one tax, that is GST. So GST, it may be intrastate or interstate. If the transaction is within the state, that is known as intrastate transaction. If it is within the states, then it is interstate transaction. In case of intrastate transactions, both the supplier and the trader or businessman or the purchaser are in the same state, then whatever GST they are paid, it is divided under 2 heads. One is CGST, Central Good Service Tax, and SGST, and it is also 50-50%. So today the GST is revised. That means with effect from 22nd September 2025, GST revised. One is 5% GST and is 18% GST. So whatever the 28% GST, it is reduced to 18%. Then there are 12% GST. Some 12% GST will be 12% and some 18% GST also will convert to 5%. So two categories only available now, 5% and 18%. So when the customer or the business purchase goods from the supplier, business has to pay GST, both CGST and AGST, if it is intrastate transactions. For example, it purchases goods worth suppose 1 lakh. Then it has to pay suppose 18% GST. 18% GST means this is total is, this is 1 lakh plus 18,000. So 9,000 belongs to the central government, another 9,000 belongs to state government. If it is interstate transaction, suppose the purchase cost is 1 lakh, GST is 18% means 18,000, entire 18,000 GST will be covered under IGST, Integrated Goods and Service Tax. Then whatever the tax paid by the businessman by purchasing goods from the supplier, that is known as input tax. It may be input, if it is intra-state, then it is input CGST, input SGST. If it is interstate, then input IGST. Similarly, at the time of selling goods to the customer, the business receives output CGST, output SGST if it is intrastate transaction, then output IGST if it is interstate transactions. Then the governments are in the GST, it is given the opportunity to businessmen to set up their input GST paid at the time of purchase from the supplier out of the GST received from the customer on sale. So previously when there was suppose VAT, then it was calculated so many times. That means the manufacturer will add the VAT. Then it will pass and he will keep some profit and it will pass to the wholesaler. And the wholesaler again will add his profit plus VAT. Then again retailer will add its profit plus VAT. Then ultimately consumer will get it at a higher price. But under GST only the tax will be given on addition. That means suppose X in the GST trader, that means registered trader of GST, X purchases goods from, suppose his supplier, purchase goods from supplier. Suppose by paying 1 lakh, then GST suppose 18%, GST 18%. That means 1,18,000. If it is interest rate, entire 18,000 belongs to IGST. If it is interest rate, then 9,000 belongs to CGST and 9,000 belongs to SGST. Suppose Mr. X, he sold the goods of 1 lakh at 1,20,000. Then GST will be on 1,20,000 into 18%. That means 21,600 is the GST received from the customer. Then the additional, that is 3,600, that means 18,000 will be set up from 21,600 and that 3,600 will be deposited under the head. If it is interest rate, then 1,800 under the head. CGST another 1,800, 1,800 on the head GST. If it is interest rate transaction, enter 3,600 will be deposited under IGST. All of you know there are certain products which are not covered under GST. They are alcoholic beverage, and here alcoholic beverage, the state will collect the excise duty plus VAT or sales tax. Then tobacco and tobacco items, then petroleum and entertainment tax, these are not coming under the purview of GST. Then regarding GST, the setup facility is like this. So setup facility under GST is then suppose this is input under IGST, then output. This is IGST, CGST, then SGST. Then here output under IGST, CGST, then SGST. Suppose here IGST is suppose 1 lakh. Then suppose here IGST output is only 80,000. So first for 1 lakh, that means output IGST 80,000 will be adjusted towards input IGST. Another 20,000, that is shortage, will be adjusted from CGST. That means IGST input under IGST is here 1 lakh, but output under IGST is available only 80,000. Remaining 20,000 will be adjusted from output CGST. Then regarding CGST, suppose CGST is 50,000 and IGST available, suppose here IGST is suppose 1,20,000. After adjusting 1 lakh, then output IGST is 1,20,000, input IGST suppose 1 lakh. Then available output IGST available is 20,000. Then for CGST, first output IGST 20,000 will be adjusted. Then remaining, that is 30,000 will adjusted from CGST. Then for IGST and CGST, for IGST all, that means first IGST output will be adjusted. Then if the input IGST is more, then output CGST will be adjusted. Then also if it is certain, that is certain, then output AGST will be adjusted. So for IGST, 3 outputs are available. For input IGST, the availability are first output IGST, then output CGST, then output AGST. However, for input CGST, the available sources are first it will be adjusted from output IGST, then if it is not sufficient, then it will be adjusted from output CGST. Under known circumstances, it will be adjusted from output AGST. Similarly, for AGST, first it will be adjusted from output IGST, then from output AGST. Under known circumstances, CGST, output CGST will be adjusted. That means input AGST will be adjusted out of output CGST. This is all about right of setup of GST. Suppose we will prepare some journal entry, post them in the ledger, then prepare the trial balance. Suppose it is given X started business with cash. First journal entry, X started business with cash. Suppose this is 1 lakh. So the journal entry is cash account debited to capital account. So we will prepare one cash account. So cash account, it is in T form. On the debit side, writes to X capital account. X capital account. So amount, suppose it is 1 lakh. Then purchased goods. Purchased goods for cash, rupees 40,000 plus GST 18%. That is, suppose it is intrastate. Then what is the journal entry? Journal entry is purchase account debited 40,000. Then 18% means 7,200. So input, this is intra, so input CGST is 50%, that is 9% of 40,000, that is 3,600. Then input SGST also, it is 3,600. So to cash account, here cash paid is 47,200. So here in the cash, this left hand side is debit side here, right hand side writes here. So we will post in the cash by purchase account 40,000, by input CGST account, that is 3,600, then by input SGST account 3,600. Suppose sold goods for 50,000 plus 18% GST, that is interstate. So journal entry is, suppose for cash, journal entry is cash account debited, that is 50,000 plus 18% GST, 59,000 to sales, that is 50,000 to output IGST 9,000. So here we have to open for one purchase account, then purchase account debited to cash, it is 40,000. Then we'll prepare another input GST, input CGST debited to cash. The amount is 3,600. Then output CGST to cash 3,600. Then for sale, we write here cash account debited to sales, debited to sales to output IGST, output IGST, sales is 50,000, then output IGST is 9,000. Suppose this is all about the transaction, then we have to balance the cash. Cash is debit balance, will total, that is 1,59,000 is the debit total, then credit total is 47,200. So 1,59,000 minus 47,200. So amount is, this is 800, then 1,18,000. So write by balance carried down. This is debit balance. By balance carried down, in the cash amount is 1,11,800. So we will close it. Then purchase account, it is debit balance 40,000. So by balance carried down, this is 40,000 purchase. Then here input from, that is output IGST, we have to, this is input, output CGST. Then we have not prepared one sales account. One sale account we have to prepare. Sales account by cash. This is 50,000. Then output IGST account will write by cash. Amount is 9,000. You see here we have to adjust the input CGST of 3,600, input CGST of 3,600 and input GST of 3,600. So that all of you know input CGST will be adjusted first from output IGST, then from output CGST. Then what we will do, by output IGST, the amount is 3,600. So this 3,600 adjusted here to input CGST. So input CGST 3,600 adjusted here. Similarly, this input CGST, input SGST also, it will first adjusted out of output IGST, then from output SGST. Then here also we'll write by output IGST. Then here to output to input AGST. So total we adjusted 7,200, remaining out of 9,000, 7,200 adjusted. Then at the end, suppose it is at the end of the year, then another 1,800 will be transferred to electronics cash ledger account. Electronics cash ledger account. The amount is 1,800. So we will prepare an electronic cash ledger account. Then we will write by output IGST, by output IGST amount is 1,800. Then we will pay cash to cash 1,800. So cash by, here before balancing we have to write by electronic cash ledger account. So it is 1,800. So 1,800 adjusted. So it is 1,10,000. So this is all about. Then we will prepare a trial balance. All of you know trial balance is a summary of what is contained in the ledger. So balance is over. So journal, ledger we completed. Now we will prepare a trial balance. So for trial balance, we will write like this. That is particulars, debit balance, credit balance. So particulars, debit balance, credit balance. Then first is your cash. Capital is also 1 lakh we have not prepared. We have to prepare another capital account. So credit side write by cash. This is 1 lakh and it will close. Then closing entry to balance carried down, that is 1 lakh. So here cash is 1 lakh, 10,000 right, cash in hand. Debit balance 1,10,000. Then capital account, credit balance. This is 1 lakh. Then purchase account, debit balance 40,000. Purchase account, debit balance 40,000. Sales account, credit balance 50,000. 50,000. Then IGST already adjusted. So this is all about the preparation of trial balance. Now total both sides. This is 1,50,000. This is only 1,50,000. So it serves as a summary of what is done. That is, this is trial balance. It serves as the arithmetical accuracy of books of account. That means there is we have prepared the correct journal, they post them in the ledger correctly, and balance also without undercasting, overcasting, balance correctly. As a result, our trial balance will tally. Then we will prepare one trading account, profit loss account, and balance sheets. In the trading account, suppose this is the case. In the trading rights, here nothing is there. By two purchase is given, the amount is 40,000. By sales is given, the amount is only, by sales is given, amount is 50,000. So gross profit is This is gross profit. Gross profit carried down. So gross profit is only 10,000. Then we'll prepare a profit loss account. Credit side gross profit, no expenditure given here. So the net profit is also 10,000. Net profit is 10,000. When net profit 10,000, we'll prepare a balance sheet. So in the balance sheet, we'll do like this. So balance as a mirror reflects the face of person. Balance sheet reflects the financial position of the concern, showing assets on one side and liability on other side. So we'll prepare a balance sheet. So balance sheet is a state financial statement. It is prepared at the end of a period, generally at the end of the financial year. So here we'll write liabilities, then amount, then assets, amounts. So here we write opening capital. Opening capital was 1 lakh. Then net profit is 10,000. That will write net profit 10,000. Total is 1 lakh 10,000. Then cash in hand also 1 lakh 10,000. So the balance sheet tallies. So this is all about the preparation of journal entries, posting those transactions into ledger, then balancing the account, preparation of trial balance. From the trial balance, we can prepare the income statement, that is trading account, profit loss account. From trading account, we will ascertain whether there is gross profit or gross loss of the business. From profit and loss account, we will ascertain whether there is net profit, net loss of the business. Then at the end, we will prepare a balance sheet. So on the left hand side, it is liability. So we'll write in order of permanency. The format of balance sheets is a liability. One is capital, second one is non-current liability, that is long-term liability, then current liability. On the asset sides, this is first the non-current asset, that is fixed asset. It includes tangible asset, intangible asset, then that is vesting assets, and current asset, that is cash in hand, cash at bank, sundry debtors, bills issued, short-term investment, accrued income, then expenses prepaid, then there is fictitious asset like the heavy advertisement expenditure incurred not at written off, then preliminary expenses not at written off, then discount on issue of share and debenture, accumulated losses. So this is all about the preparation of balance sheet. Thank you for watching this video. Don't forget to like and share the video to all of your friends so that everybody will be benefited. Please subscribe if not subscribed.